It does, and in DeFi, the majority of the money is donated by strangers on the internet. As a result, the entrepreneurs driving these decentralized banking applications devise ingenious strategies to attract hodlers with idle assets. The primary concern of all of these different products is liquidity. That is, how much money is locked up in their smart contracts. If you have liquidity in particular types of items, the product experience improves significantly. Instead of borrowing from venture capitalists or debt investors, you borrow from your customers. Avichal Garg, managing partner at Electric Capital, stated. As an example, consider Uniswap. Uniswap is an AMM, automated market maker, another DeFi term of art. This means that Uniswap is an internet robot that is constantly eager to purchase and sell any cryptocurrency for which it has a market. Almost every Ethereum coin has at least one market pair on Uniswap. Behind the scenes, this means that Uniswap can appear to be performing a direct transaction for any two tokens, making it convenient for users, but it's all designed around pools of two tokens. And all of these market combinations do better in larger pools. Let's have a look at how Uniswap works to see why more money is beneficial. Assume there is a market for USDC and DAI. These are two tokens, both stable coins, but with distinct systems for keeping their value, that are supposed to be worth $1 at all times, and both are generally true. The price displayed by Uniswap for each token in every pooled market pair is determined by the balance of each in the pool. So, for the sake of illustration, if someone wanted to build up a USDC/DAI pool, they should deposit equal amounts of both. In a pool with only 2 USDC and 2 DAI, the pricing would be 1 USDC for 1 DAI. But suppose someone put in 1 DAI and took out 1 USDC. The pool would then have 1 USDC and 3 DAI. The pool would be completely out of balance. A wise investor may profit 50 cents by putting in 1 USDC and receiving 1.5 DAI. That's a 50% arbitrage profit, which is the issue with restricted liquidity. Incidentally, this is why Uniswap's pricing tends to be correct, because traders monitor it for minor differences from the wider market and trade them away for arbitrage profits relatively rapidly. However, if the pool had 500,000 USDC and 500,000 DAI, a trade of 1 DAI for 1 USDC would have no effect on the relative pricing. That is why liquidity is beneficial. Markets demand additional liquidity because similar effects hold true throughout DeFi. Uniswap solves this problem by collecting a small fee for each trade. It accomplishes this by taking a little portion of each trade and depositing it in the pool, so 1 DAI would actually trade for 0.997 USDC, after the fee, growing the overall pool by 0.003 USDC. This benefits liquidity providers because anybody who contributes liquidity to the pool owns a portion of the pool. If that pool has seen a lot of trade, it has earned a lot of fees, and the value of each share will rise. This leads us back to the subject of tokens. A token, not an account, represents the liquidity added to Uniswap. So there is no ledger entry that states, Bob owns 0.00000678% of the DAI/USDC pool. Bob carries only a token in his wallet. And Bob is not required to keep the token. He could try to sell it. Alternatively, incorporate it into another product. We'll return to this, but it helps to explain why some refer to DeFi devices as money Legos. It can be far more profitable than placing money in a regular bank, and this was before firms began issuing governance tokens. Let's look at Compound as an example. As of January 2022, a person can deposit USDC or Tether, USDT, into Compound and earn approximately 3% interest. Most bank accounts in the United States now earn less than 0.1%, which is close to nothing. There are, however, certain drawbacks. First and foremost, there's a reason why the interest rates are so much higher. DeFi is a significantly riskier place to park your money. These funds are not insured by the Federal Deposit Insurance Corporation, FDIC. If there is a run on Compound, users may be unable to withdraw their funds when they desire. Furthermore, the level of interest is highly variable. You have no idea how much money you'll make in a year. The USDC exchange rate is currently high, but it used to be in the 1% level. Similarly, a user may be enticed by assets with higher returns, such as USDT, which normally has a considerably higher interest rate than USDC. The trade-off here is that USDT's transparency on the real-world dollars it is meant to keep in a real-world bank falls well short of USDC's. A difference in interest rates is frequently the market's way of indicating that one product is regarded as riskier than another. Because there are no regulatory protections in this fledgling market, users who make large bets on these products turn to organizations like Open and Nexus Mutual to ensure their investments. More on the numerous hazards later. As a result, consumers can invest their money in Compound or Uniswap and earn a small yield. That, however, is not particularly imaginative. Users who hunt for angles to optimize productivity are known as yield farmers. Yield farming, in general, refers to any endeavor to put crypto assets to work and create the highest potential returns on those assets. At the most basic level, a yield farmer may transfer assets around inside Compound, always chasing the pool with the highest APY from week to week. This may need shifting into riskier pools on occasion, but a yield farmer is capable of dealing with danger. Farming creates new price arbitrage that can spill over to other protocols whose tokens are in the pool, said blockchain consultant Maya Zahavi. However, because these positions are tokenized, they have the potential to go further. In a nutshell, a yield farmer might invest $100,000 USDT in Compound. They will receive a coin called CUST in exchange for their stake. Let's say they get 100,000 CUST back. The math on Compound is insane, so it's not exactly 1-to-1, but that's irrelevant for our needs. They can then deposit the CUST into a liquidity pool that accepts CUST on Balancer, an AMM that allows users to create self-rebalancing crypto index funds. In typical circumstances, this could result in a minor increase in transaction fees. This is the fundamental concept of yield farming. The user searches for edge cases in the system to extract as much yield as possible across as many goods as it will support, as a result of liquidity mining. Liquidity mining boosts yield farming. In exchange for the farmer's liquidity, a yield farmer receives a new token as well as the standard return, the mining part. The concept is that encouraging platform utilization improves the value of the token, generating a positive usage loop to attract users, said Richard Mott of smart contract auditor QuantStamp. The yield farming examples presented above are merely farming yield from the usual activities of various platforms. Provide liquidity to Compound or Uniswap in exchange for a small share of the business that runs across the protocols. Extremely simple. However, Compound declared in 2020 that it planned to truly decentralize the product and provide a significant portion of ownership to the individuals who popularized it by using it. The Comp token would serve as proof of ownership. To avoid sounding overly altruistic, consider that the people who developed it, the team and the investors, controlled more than half of the equity. Giving up a healthy chunk to users was extremely likely to make it a far more popular loan location. As a result, everyone's investment would be much more valuable. So, Compound declared a 4-year time frame during which the protocol will distribute a fixed quantity of Comp tokens to users every day until the supply was depleted. Comp tokens control the protocol in the same way that shareholders ultimately control publicly listed firms. Every day, the Compound protocol looks at everyone who has given money to the application or borrowed from it and awards them Comp proportional to their percentage of the total business for the day. Even Compound's greatest supporters were taken aback by the results. This was a completely new type of yield on a deposit into Compound. In fact, it was a technique to generate a loan yield as well, which is really strange. Who has ever heard of a borrower receiving a return on their debt from their lender? Comp's value peaked at more than $900 in 2021. We conducted the calculations elsewhere, but the long and short of it is that investors with very substantial funds can make a significant profit by optimizing their daily returns in Comp. In some ways, it's like getting free money. You can lend to Compound, borrow from it, deposit what you borrowed, and so on. This may be done several times, and DeFi startup Instadap has even developed a program to make it as capital efficient as possible. Farmers with high yields are incredibly inventive. They figure out how to stack yields and potentially earn numerous governance tokens at the same time. DTC Capital's Spencer Noon stated. The increase in the value of comp is a one-time occurrence. The comp distribution will last only 4 years, after which there will be no more. Furthermore, most people believe that the current high price is being pushed by the low float, the amount of comp that is truly free to trade on the market. It will never be this low again. As a result, the value will most likely progressively decline, which is why knowledgeable investors are attempting to make as much as they can now. Appealing to the speculative tendencies of ardent crypto traders has shown to be an excellent approach to enhance compound liquidity. This not only fattens certain pockets, but it also improves the user experience for all types of compound users, including those who would use it whether or not they were going to earn comp. When entrepreneurs see something successful, they mimic it, as is customary in the crypto world. The next system to begin distributing a governance token, BAL, to liquidity providers was Balancer. Following suit was BZEX, a provider of short-term loans. REN, Curve, and Synthetics have also joined forces to establish a Curve liquidity pool. Many of the more well-known DeFi initiatives are likely to unveil some form of token that can be mined by providing liquidity. The case to keep an eye on here is Uniswap versus Balancer. Balancer can accomplish the same thing as Uniswap, but most users who wish to transfer tokens quickly through their wallet choose Uniswap. It will be fascinating to see if Balancer's BAL token can persuade Uniswap's liquidity sources to switch sides. However, according to its statistics site, additional liquidity has entered Uniswap after the BAL announcement.